Nope, there's nothing wrong with your audio. It just takes a minute. I gotta get everything linked. I need like some elevator music or something playing in the background, but I'm sure as soon as I try that, they're gonna hit me with some sort of copyright infringement. I need to get maybe some 5-gallon buckets and spoons and just beat on them like they do in the city. You know, put a little beat on there. Good morning, everybody. TGIF. Yeah. I mean, I've thought about it a couple times, but it's those copyright infringements. Yeah. So right now we're looking at the FedWatch tool. Powell had an opportunity this week to really rein in the markets, and it was notable that he did not. So he didn't. And when it comes to the Fed, even 10 years ago, there was a lot of wink and nod on their messaging. And they were infamous for their horrible messaging, and I'm sure you've at least seen one Saturday Night Live skit where they've talked about thinking about having a discussion about thinking about cutting rates or some kind of silly trash like that, right? That they just are notoriously inefficient at messaging. But some of that still exists today. And that would be the noticeable lack of a pushback against this bleed up in the markets. So we're looking at the June projected rate cuts, right? And this is the market's trades. This is their perception of if the Fed will cut and when and where it will cut. You can look 1 day back, 1 week back, or even 1 month back, and you can check the different FOMC dates that are on the table and kind of get a feel for, are they unwinding something they had already priced in? Are they pricing in something? And what you want to look for is, when is the first projection really starting to get priced in? So what you want to see, this is where we are now. Don't make it confusing on yourself. Just pick one number. So if we say it's 550, then that's the number we'll use. If you want to say it's 525, then use that. But using the spread, if you're new to all of this, it's just going to confuse you. Just pick one number. Then look at the bars down here. So if I'm on June and the biggest bar is 500, and we're currently sitting at 5.25, then they are projecting a rate cut with a 58% chance by or at June 12. So if we jump ahead to, say, December, look at the biggest bar, 425. The projections are that between now at 525, that we'll be down to 425 by December 18. Each rate cut is 25 points. So this would be 4 rate cuts by December. Now, the Fed has signaled last year in November that they were thinking about 3 rate cuts. Since then, there's been a little bit of a hint that it might only be 2. So 4 still seems a little exaggerated. The bond market is actually pricing in 1. There's still, a lot of confusion out there. This goes back to the Fed and its inability to signal properly. So you want to look at this over the weekend and really see by Monday where we're at, right? Because what we're going to get today that may radically alter what we have on the table is non-farm payrolls. Yeah, baby. There's 3 times a month where we get an 8:30 print that just might offer us a liquidity gap play. Today is one of those days. Non-farm payrolls. I like to provide examples of what a trade strategy looks like so that people understand what it is that we're looking for. This is the play, and I know you don't see a gap, you see a candle. I call it a gap. It's a liquidity gap. If you get into reading the tape, looking at liquidity using something like Jigsaw or Bookmap, reconstructed order flow, then you would perhaps understand a little more where the gap is. Gaps create a vacuum. Price doesn't like gaps and it wants to close it. So at 8:30 today, we have a chance to get one of these candles. I don't care if it's red or green, blue on my charts, but it doesn't matter. I don't care if it's bullish or bearish. We're looking for one direction. Notice there's no real wick to the upside of this candle. It went straight down. Then we based and consolidated, and we made it back to the gap close by around 11 o'clock. I watch the clock. Time has a lot to do with the way I trade, so I tend to pay attention to when things happen. We got back by around 11. Now, some traders trade the move as it's unfolding. Some like to get in along these lows and run it back up. You do you. There's no wrong way to go. Destination is the point of all of this. If you and I get in our cars and both of us go to the grocery store, you may take one route, I may take another route, but we're both going to the same spot. I know where you're going. You know where I'm going. In a trade setup like this, how you get in is on you. That's your business. You know the destination. So what's it worth to you? What size stop are you willing to use? Are you going to hold through the whole thing, or do you get in and out? Those are decisions for you to make. Here's another example, a positive one rather than a negative one. Still one direction, a single push, no real wick to the downside. Not much consolidation either. This one didn't really base. It just shot up there and then ground itself back down, got there about 11 o'clock. This one, we had multiple candles to the upside, not just one single candle, but we still didn't get any downside volatility in that initial push. So it wasn't a single shot, but it does reiterate the point. We want one direction. This little bit of wick up here isn't too bad, but what you don't want to see is a lot of pullback on any of these candles. Right? It needs to top out first or bottom out first. Then we can start getting some wick. So this is a little sloppy. I mean, it got the job done, but kind of didn't like it. We got the gap closed around 11 o'clock. Now, I'm showing the ES, but it doesn't have to be. If you want to do it on the NASDAQ, do it on gold, oil, whatever. Liquidity gaps happen all the time. Intraday, after hours, pre-market. These are bigger and more eventful, and they often can take hours before we get it filled, but you'll often find these gap play setups even through the intraday, and they usually get filled within the hour or so, 30, 45 minutes. So this is not ES specific. I'm using a 5-minute time frame on these pictures, but you don't have to, right? If you have a different time frame that you like, then it still comes back to destination. You're expecting price to go back to where it was at 8:30. It doesn't matter if you're on a tick chart or anything else. You know where price was at 8:30, mark that spot. That's where price is supposed to go back to. So this one unfolded really fast. We got back there within 30 minutes. A little unusual, but it did get the job done. Notice also in this one, this really long wick across the top. Remember, I mentioned I don't like that. It makes it sloppy. It starts to degrade the setup. Um, I don't trade in that time period between 8:30 and 9:30. So for me, this was just a no play at all, but it still shows that we got back to the gap close. This is what we don't want to see. I think when presenting strategies and setups, just showing you really good, really amazing setups that worked perfectly and only showing you that is doing you a disservice, right? You need to know what you don't want to see. And this is what you don't want to see. Big wicks on each side. And sure, it did come back and close the gap, at least from the close of the first candle. We got back there. We didn't necessarily make it back to the 8:30 open, but I mean, that's pretty close. But this is sloppy trash. It's not what we want. That doesn't mean that you have to sit out for the rest of the day or that there's no trade. You can still trade other setups, other strategies. It just won't be the gap close strategy because there is no gap close here. As far as I'm concerned, the whole thing is scratched at this point. It's another example, same thing. Big wicks in each direction. There's nothing here. And we got back to the gap. So it was technically a gap close, but this isn't what I want. I wouldn't play it as a gap close. It's another one, same thing. Big wicks on each side, right? So it's not a complicated setup. It's not a complicated strategy, and you can trade it anywhere. We have that on the table today at 8:30. And remember, no matter how bullish or how bearish the market is, it can change within the first 30 minutes. And there's a 50% chance that it will. 50. So for you newer traders, it's easy to get sucked into the hype of the morning that, oh, we're really bearish, we're really bullish. There's a coin toss chance that we're going to change directions in the first 30 minutes of the day. That is a statistic that should weigh heavy on your mind when we open at 9:30 and pop hard to the upside just long enough to grab all those bulls and get them into the market, and then we rotate, flip them on their head and drop them. Right? That's kind of the whole point. That's the play. So this gap close is no different. We look at a market making a single directional push and then to stabilize, and we run it back the other direction. Non-farm payrolls is kind of a big deal. The markets know that. So around the world, most of the markets are flat. We do got a little bit of outliers, 0.5% in UK, Japan down more than 0.5%. And on the other side, the Euro Stoxx 50 up more than 1% this morning. In between all of that, got the Russell at 1/4 to the downside, the NASDAQ a little more than 1/4, and then the Dow behind that. So, you know, the S&P closest to zero out of all of them, but still down. This is a market waiting for data. You might notice there are a couple of futures trading platforms that are already rolling over into the new contract. We still have one more week. OPEX is next week. If you're ever in doubt of how to find that, it's a third Thursday of the month is expiration on options and all sorts of things. And when it is an expiration month for futures, it'll be on that third Friday. I know I just said Thursday, but third Friday of the month. So we've got one of those coming up. I've seen some platforms are already rolling. Others, you have to roll manually. If you are one of those people that need to roll manually, I'll show you a little trick in a minute to gauge for yourself if you should roll yet or not. So as you can see, we got a lot of things on the table today. And Sunday night, we're going to get a lot out of Japan. There's been a lot of whispers that Japan may end this decades-long experiment that they've been doing and actually start raising rates. And gold is pricing in that rumor. So just kind of keep in mind, if you're long gold, one of your threats is news out of Japan. That's not the only thing, but that's a big piece of it, right? I've seen some projections of US dollar Japan down into the 130s, and that would really send gold to the upside, bring the 10-year down, the dollar down, equities up. So I don't know. I think there's more to it though, right? I think there's a blind spot to it all. It might not all just be rainbows and sunshine. The main thing for today is once we get past the CPI, the non-farm payrolls, we're next focused on CPI next week on Tuesday. That'll be the next biggest thing. Now, on a day like this, it doesn't do us a lot of good to crawl through the equities and see what's up or what's down, because all of that's going to change after we get this data print. They are hedging this morning. We can see that because we have a market maker move up here. If you're on a platform that does not have market maker move, come into the options chain. And what you want to see is that the front expiration is higher than the next expiration out. They call it the front. So if the front end is higher than the next one out, you have what we call a market maker move. This is something that Thinkorswim concocted. They just made it up. So there's no science or magic behind it. It's just math. And they attached a name to it that sounded good, get people's attention. They were trying to market themselves when they were a newer company back in the day. And market maker move, I mean, that just sounds pretty cool, especially if you're talking 20 years ago, right? When trying to distinguish yourself against places that's been around since trading on computers, you know, like E-Trade or something that's been around forever. And they were trying to knock them out and dominate the scene. It's just math. It's just these two numbers. If you don't have a little label indicator that says market maker move, you know where to get it now. And that's not just a futures thing. That's anything that has options. You can go into the options chain and you can see that. So we have a market maker move today. Let's go back there for a minute. Got to talk about rolling. On whatever futures platform you have, bring up both contracts, the H and the M, and look at the volume for both. On my Trade-of-8, I've got watch lists that are set up so that I can see the mini and the micro, and that I can see both contracts, the current and the next one out. Look at the volume, whichever one is the dominant, that's the one that you want to be on. And what you'll notice when we come in next week is that this M series is going to be the one that's dominant. Thinkorswim does it automatically. If you type in ES, it will just automatically assume that you want the front one, but it will stop showing you the front one on its own. It just changes to the next one. So you don't have to do anything with Thinkorswim. It'll just do it on its own. Some of those other platforms like Trade-of-8 will do it on its own if you tell it to. So far this week, we haven't really gotten anywhere other than we held what we had. We didn't give anything back, and we're still trying to complete this breakout. depending on how the news goes this morning, we're going to get this breakout or we're just not, right? There's not going to be a lot of ambiguity to this. If you want to understand more about the kind of moves that we can get during these economic events, go Google non-farm payrolls and look at the last 2 years. You get one a month, so you're looking at 24 events, and you've got 24 examples that you can study and look at what price did on those days. Then you'll have a better idea of what price could do today. We had a really nice recovery. If you look at these wicks on the bottom of these candles, they really defend this low. Every time we pull back, they've been right there, willing to step up and run it back. So far, we still have that. And if you looked at the flows this week, it's still very bullish out there. So even if things get negative today, I don't see that they're going to be negative enough to put us in, a correction of size, like 7%, 10% over, like a swing trade pullback of that size. I don't see it. We may still get this choppy kind of grind higher in the indexes, but in equities, things just look completely different, right? And the outflows on the FANGs, I didn't catch the number, but it was big. Just this week alone, the outflows on FANG names is still significant. So the rotation out of the overcrowded trade in the FANGs, that's still continuing. And the money isn't just leaving the market. That's not how it works. If they're leaving the FANGs, they're going into something. And that's always the trick, right? Trying to find the next sector, the next industry, the next rotation. Right now, it's pretty much everything else other than big tech. So most of these levels and lines that we have here aren't going to do us any good when the report comes out. The pivot points are not designed for that. The fear and greed and the report that we get will be more powerful than any pivot point that we can put on the screen. So they're not going to be useful. Just get all of that out of the way, clean everything up real quick. We got our ADR levels. What we do with the market maker move is we add it to the top line and we subtract it from the bottom line. So take 51.10, subtract another $28 from that. Then we would get our lower level. Take $28 and add it to the top side and we would get our higher level. That gives you just the normal move that we could make today. That's not an outsized move. We're not even reaching yet. That's just like another day at the office kind of move. That's nothing. If we want to know what it would look like if we get really nasty data and the market is way off sides, then we would take the entire expected move or average daily range and project that up or down. Even if it was just to do 50% roughly on top of the market maker move. So 28 and 8, 36. That'd be 52, 36. It's close enough. $52.62. And 50.80 to the downside. Now, I'm not getting exact, just kind of rounding, but there's your next level out if things were even to just get a little wild today. 50-50 to the downside and 52-60 to the upside. It's not bad, right? It's a 200-point range on the day. I don't think we're going to get that kind of data today, right? The only thing that would really move us that far is if they were caught off sides and caught off guard. But this tells us that they're hedging. They don't have to sell. You're not off sides if you're covered both directions, right? And that's what hedging gets you, is covered on the other side of your trade. So if you're long, you're hedged to the downside. If we go down, you don't have to sell anything. You're not scrambling. You're not off sides. You're covered. The more worried they are, the more they'll hedge, and the more they will compress this price move. So we could see some volatility for sure. We could get a little violent, yes, but with the hedging in place, we're not expected to see some real big outsized moves off the top of the announcement. But through the day, we could continue to grind and get farther and farther and farther. That's where these outer levels would be. I don't think we're going to get that, but you know how to find it. We talked about this range getting narrowed all week, and hey, we got it. It's narrower now. Point of control is still below us. It matches with the TPO point of control. Everything is lined up nice. We've got like a classic D shape. It's not very pretty, but it is there. If we hold this zone long enough, I think we could start to build out more of the classic B. Other than that, there's a little bit of a shelf at 51.50. Breaking that gets a little shallow, so we could fall down into the point of control from there. Be around 5100. We didn't really have a chance for a VPOC last night. We hit it really early, about 7 o'clock, and then we completely ran it over. So if there was any doubt, which there wasn't, we removed that doubt when we got this drop down here. So no VPOC. And we ran one over that we talked about yesterday, the one at 51.40. Before I take them off, I always like to zoom in and take a look at what price did at that level. It really didn't respond or do much this time. But we're done with it. Take it off. So we don't have a new one to put on. We've got a little bit of a discrepancy at the moment between the TPO on the 5-minute and the volume profile on the 5-minute. We've spent more time by volume down here, and yet we've had more trades by price up here. So it's like we hit a little bit of something, and I bet if we were to go into a TPO chart, or maybe a monkey bars on Thinkorswim is what they call it, we probably hit a lot of liquidity right there. But we don't have to assume, right? We can go into one of those charts if we needed to and really kind of flesh that out. What's interesting is also this volume down here. So we can see them defending that position. But at this point, we're just waiting on time. We have next week's box already. Now, this box is not set in stone. It won't be locked into place until 4:15 tonight. But it's like a preview. We get to look at it all day today. And as price goes up and down, these three lines are going to shift up and down with price. As volatility expands and contracts, this box will expand and contract. Now, this box is based on next week's options right here. It's this range. Next Friday's range is $91.50 higher or $91.50 lower. Since it's the ES, it's points instead of cents, but whatever, right? Same thing. You can do that on SPY, the Qs, Apple, it doesn't matter. That's next week's expected move, 91 higher, 91 lower. But that's not set in stone yet. The market hasn't reached 415 tonight. It's not locked into place. This is what we call a static expected move. It's static. It doesn't move once we lock it in. Now, every single day there's an expected move, even for next week. If we look at next Friday's expected move every day, look at it today, Monday, Tuesday, it's just going to get smaller and smaller because we're running out of days. And each day that goes by, how much farther we could move gets reduced. That's a dynamic expected move. It's constantly changing. It's dynamic. This is static. So it's moving today because it's not locked. But at the end of the day, it'll be locked, just like all these old ones are locked, and it won't move. But what we want to know for next week, kind of a preview, is how does next week compare to the week that we just went through? And we can see that next week is projecting a lot of volatility. No, the expected move, well, this one on the screen is using this. And these are a proprietary math formula that every broker has. That's why the one you see on Thinkorswim might not match the one on Tasty or IBKR, Webull. Every company has this expected move, and every one of them does the math just a little bit different. I know some of the formula. If you want to know what I know, it uses all of these out of the money options on the put side and all of the out of the money options on the call side. You can see the implied volatility column. That's what it's going to add up. It's going to add all that, and it's going to add all that. And then it's going to divide by however many it did. And then it uses how much time we have left with a square root of time formula. Then there's some proprietary stuff that they won't tell us they're using, and then they give us this number. But they don't, it's a closely guarded secret. They don't share that last little bit. So, I mean, it's always cool to know how things work, right? And to be able to recreate things for ourselves, but there's just some things that we can't. As long as we know where to get the data, though, we don't have to, right? We can just go in and get the distance and mark it out on our chart. So what we can see at this point is that next week's volatility is much bigger than this week. And I mean, this was a pretty big week, right? We had Powell in Congress, non-farm payrolls. We had a rate decision coming out of Europe. And yet, next week has a lot more volatility than this week. So that's a little bit of a heads up or a warning. If you normally play like a weekly expected move iron condor around these levels, you're not going to want to do one next week. The OPEX next week is kind of a big deal. If you get a chance to read Spot Gamma, the founder's notes that I shared from last night, they always do a really good job of pointing out volatility risk and what's on the horizon. They didn't have the AM at the time that I was getting ready to start, so I only shared the PM, but I just looked, and they do have the AM done now. So just give me a second, and I will throw that out there for everybody. All right. So that's the AM. And obviously, I haven't read it yet because they came out with it while I was talking with you guys. But you're going to want to read it. They do a really good job of talking about forward expectations and volatility and risk. So, so it's a darn good read. Um, I share that with you guys so that you get a chance to see what a very expensive service has to offer. Um, they're worth every penny, but if you're not yet a successful trader, you're probably going to find it hard to justify getting a subscription to something like that. I don't think that it's a big deal to share, so why not give it to you? None of these other data points, the dollar, the 10-year, the ZB 30-year bond, none of these others are going to have any impact on the market or where we could go or how far the move can be. It's all going to come down to the data that we get today. So just kind of keep that in mind. No amount of technical analysis, no pivot points, nothing is going to give you an idea of the move that we could get. What we can say for sure is that they're hedging, that the initial move very likely won't be extreme, meaning it won't hit these lines that I drew, and that we are starting the day pretty much, well, we've fallen enough now, but we were starting pretty much in the middle, right? Which is, it's nice that we're in between those two red lines, because what's the average daily range represent? It's what we do on a day-to-day basis, right? It's what's normal. So hitting one of those two lines would be the normal thing to do. The coin toss is, which one are we going to hit? When we're in the middle, it really is a coin toss. But the closer we get to one, the more likely it is we're going to go to that one. Not true on non-farm payrolls, not true on events. We can be, halfway between these two. If that's the start and that's the end, we could be halfway there, get non-farm payrolls and just go to the other side. Same thing. We could be halfway there and we could go to the other side. So with events, everything gets taken off the table until we get the event. Then we reevaluate, lay out our levels, go from there. That's what we want to focus on. As a minor point, if we do go to the upside, we've already tested the liquidity that was up here. Liquidity resides on the other side of the pivot. I say it all the time. We got into it a little bit earlier. If you have a platform like Footprint Charts, TPO Charts, on Thinkorswim, Monkey Bar Charts, if you can go back and look at the trading around that zone, the liquidity, how we hit it, engaged with it, that'd be a good thing, because if we go back up there, one of the questions we want to ask is, are they still up there? Is there anybody left? Is there any unfinished business at that zone? It's going to make it harder to get through. Everybody watch the clock. Have a good weekend.